Hello, everybody, and welcome back. Today, my guest is Gerwin Bell. Gerwin is an Asian economist at PGIM. Welcome, Gerwin.
Thanks, Thomas. Thank you for having me.
Gerwin, today we want to discuss recent economic developments in China. So, talk of the town, there are signs of rising default rates of state-owned companies in China. So, what is your opinion on the current development?
The current development is not that different from past developments. So let me backtrack a little bit. First, backtrack, say, over this year, and what we have seen in China is a significant surge in the debt ratio again. That has scared the official sector in Beijing, and they're trying to see what can be done about this fast pickup in debt observed this year. Concerns about rising debt, of course, are nothing new in China. You saw them intermittently after the 2008-2009 stimulus. You saw it again in 2012. And after each and every these rapid surges in debt, the Chinese have tried to what they call delever. The additional wrinkle this time around is the role of the bond market, in that a lot of non-traditional debtors were able to finance themselves not in banks, not in shadow banks, but this time by access to the corporate bond market. And I think the current state is one where regulators think they want to prune some of the excesses. I would be cautious on extrapolating their current stance too far out, because in each of the episodes in the past, we saw that efforts at deleveraging led to lower growth, led to more problematic unemployment problems, led to stress in financial markets, and eventually official Beijing relented, and we saw a resumption of lending and stimulus. And I would think that unless we're going to get a significantly lower growth target in the next 5-year plan that we just discussed and adopted in March, or we get a step back from the official planning of the economy in certain directions. Each of these are very debt intensive. So unless we get progress on that front, I would think this deleveraging drive then ends like all the other, and we're going to go back to rising debt shares in China.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now. So China's economic recovery seems really remarkable given the problems that we are facing in the West. In a recent paper, you've described this as particularly not very sustainable. How come?
You're right. It seems remarkable, and it is if you look at the number. But the caution I would urge is one that what we see this current Chinese recovery is very similar to the old Chinese recovery, namely based on exports and based on investment. And even the Communist Party in China has told us that this is not sustainable and needs to be rebalanced. So let me just quite quickly explain why we arrive at that point. With the virus pandemic, we saw varying policy responses in the world. In the Western countries that your viewers will be more familiar with, we saw a preponderance of effort in order to try to minimize income losses for consumers and also to corporations. Conversely, production was locked down and supply chains were severely hit. That's the exact opposite of the approach that the Chinese policymakers made. The Chinese policymakers prioritized production fairly early on and never really got quite around to providing this significant income stimulus to households that Western economists did. So that gave us a very mirror image way of recovery. Now, what happened in the West, people were insulated on the income side, so they had spending power. yet production was locked down. So some of this additional spending needed to be produced elsewhere, enter China. China is exporting its production that is running well into Western countries. And I would note that many people say, well, but that is just medical equipment. That is no longer true. It's the goods sector at large. So leaking stimulus elsewhere from the West is a key supporter for the Chinese economic recovery. Exports are surging in China. In addition, the trade surpluses of China, especially with the US and Europe, are also surging. So that is unlikely to be sustainable. Another element that is not sustainable, which brings to your first question, is the investment stimulus that China provided. Contrary to what is perceived in the West, China did stimulate, but the stimulus relied on official infrastructure investment and officially tolerated property investment, both of which once again inflated the debt bubble. And you already see that the authorities are trying to claw back. So the ultimate verdict is this a sustainable recovery? I think this we need to see how this plays out.
You observed that Chinese investors withdrew money, especially in second and third quarter of this year, while on the other hand, the Chinese export engine is running and economic surplus is rising. So how does this fit together?
Well, it doesn't fit at all, and actually, that is one of the puzzles that we deal with this year. You're right. I mean, trade surpluses are very large. Current account surpluses are even larger because the traditional Chinese services deficit has all but disappeared as Chinese tourists are no longer leaving the country. So, rising current account surplus. In addition, we have surging bond inflows into portfolio bond inflows into the Chinese bond market as broader investment indices start to include and raise the weight of China. So very big current account surpluses, very big bond inflows. Yet if we look at the bottom line of the balance of payments, which is foreign exchange reserves, we see no change. Actually worse, once we adjust for the valuation of foreign exchange reserves, they are declining. So how can that be? We have massive inflows on the current account and the bond side, yet the actual balance of payments position is worse. There are some hypotheses there. I mean, it could be, for instance, that the Chinese banks are building up their foreign assets, which would be a negative balance of payments flow. But to the extent that we can observe it, they nowhere near explain this phenomenon. Could also be that the People's Bank of China is engaged in forward intervention or rebuilding a forward book that they ran up in 2015. That would be positive by and large. It could also be that there are massive outflows to Hong Kong in perception of them being more integrated into Chinese markets or large IPOs. But it could also be that households and corporations are taking money out of China. That would be problematic. And that still, and notwithstanding what you hear from some of the analysts who place high hope in internationalization and capital account opening, China's debt sustainability rests with keeping household deposits in the banking system. Also deposits in the banking system. Bank deposits in the banking system are about 200% of GDP, which backs a debt burden of some 270%. Should these deposits flow out, the debt situation in China would become a lot more tricky. So I can't tell you what really the drivers are, but I can tell you that we are intricately monitoring the situation.
During the COVID-19 crisis, China restrained itself from taking massive fiscal and monetary measures in comparison to the West. Has this been the right answer from the perspective of the Chinese government on the situation?
I think the Chinese government are very pleased with what they have done, especially in international comparison. The question, though, is is this too early a victory role? And there, I'd suggest caution. It is true that on the monetary side, stimulus has not been large on the interest rate side or on the money supply side. But as we already discussed, there has been significant quantity stimulus in terms of credit. And actually, with the high interest rates in China, that adds to the debt service burden. And that certainly is a factor in the in this renewed SOE stress that we discussed earlier. The second point I would make is, yes, the change in the Chinese fiscal deficit is not that large. I mean, we estimate it's about 5 percentage point of GDP, from about 13% of GDP to 18% of GDP this year. Other estimates, from the most recent one by JP Morgan, are somewhat larger. They think there will be a somewhat larger extension to a deficit of 20% of GDP this year. So that would be on line with the high deficit in the US. It's just that Chinese deficits had traditionally been very, very large. So the additional delta, there's not that much additional support to the economy. However, all this debt, is it additional or not, will need to be financed. And as I said, the official Beijing, and particularly the regulators, are getting very worried about the next surge in the debt ratio, and they're trying to clamp down on this. Will this be successful? It depends. I think one part of the solution will have to involve lower interest rates, so that you actually will see an interest rate cut or more cuts coming from China. But as I said in the beginning, I mean, the debt dependence in China, whether it's for stimulus or it's just ongoing debt growth, has to do with too ambitious growth targets. And unless they get changed, we will see this problem arising over and over and over.
So the Chinese debt discussion is back in financial markets. To what extent does the current situation limit the possibilities of the Chinese government to reduce debt and get the shadow banking system under control?
It's a very interesting point that you raised, the shadow banking system. Because one thing we see is that the shadow, in all this increase in debt that we saw this year, the shadow banking contribution was actually strictly minimal. Indeed, that reflects one of the key priorities of the Chinese authorities over the last 3 years, namely the introduction of a corporate bond market, which allows other investors other than banks via off-balance sheet vehicles to lend to companies. Well, that's only half the truth. Now we see, of course, that a lot of the lending in the bond market, notwithstanding very favorable Chinese onshore ratings, is actually probably of very low quality. And if you look at the last 3 defaults that happened, I mean, it's a question why anybody would have lent to these companies to begin with. So the non-traditional financing problem this time around does not show up in the shadow banking system. It shows up in the bond market, in the pride of a recent Chinese financial innovation. So it's very understandable that the Chinese authorities want to safeguard progress there, but they have to be very mindful in not topping the apple cart here, because a lot of bonds, corporate bonds, are highly problematic. And I can tell you, as an investor, that's an area we're very constructive on the Chinese government bond market. We're constructive on policy banks. On the rest of the Chinese bond market, we still have to warm up. And there's a risk that rather than us sharing a more bullish view on the corporates onshore bond market, that investors in the existing investors in China's corporate bonds may adopt our more pessimistic view on that matter. I think in the near term, you'll see less than people kind of usually assume. On the one hand, I mean, the Trump administration is obviously trying to ring fence its China policies via executive orders that are coming down apparently recently day by day by day by day. So that will take some undoing in the Biden administration. Even if it is just executive orders, which in principle can be reversed easily. The reason for that is that in the US, China's skepticism, to put it mildly, is a bipartisan objective. There are not many bipartisan topics left in the political debate, but skepticism vis-a-vis China is one of them. So the political room for the Biden administration, even if it wanted to move to a more aggressively pro-China policy, would be limited. So on the immediate future, I would, in a Biden term, would look toward no further escalation rather than a fairly rapid de-escalation. It should also note that when it comes to questions like trade agreements, the comprehensive Trans-Pacific Partnership that the Japanese and others still hope the Americans might join, or the Regional Comprehensive Economic Partnership that was spearheaded by China and Japan. Mr. Biden himself and his party were actually the ones most skeptical of the TPP. Indeed, it wasn't the Obama administration did not dare submit it to a congressional vote for fear that Democrats would veto it. So I wouldn't expect much on trade liberalization either. What I would expect, though, is more emphasis on multilateral approaches again. That bodes well for all of Asia, not just China. But rather than this transactional one-on-one approach, we deal with these countries together in their normal institutional settings and regional settings. That is a benefit for all of Asia. To what extent it will permit China to do better will also depend a bit on Chinese efforts to satisfy more multilateral organizations. One thing, though, I think we can be fairly confident on is that the escalation of financial sanctions will stop. If you look at the nomination, presumed nomination of Janet Yellen as Treasury Secretary, she's somebody who is intricately familiar with the workings of financial markets. She also intricately knows the benefits of financial markets and the risk posed if you really go too deep on the sanctions front. So the big impact I would expect on easing of financial stress and sanctions, not just with respect to China, but hopefully with respect to other areas as well.
What does it mean for the Chinese bond markets? What will be the effects for fixed income investors in the near future?
We as a firm, we have been very positive on the Chinese bond market in that it's offering significant diversification prospects and also a value. And that is primary, or so far we're willing to make that point for the government bond market and the policy for policy bank bonds. Future prospects are also quite good because, as I mentioned, we think that interest rates in China will come down at very, very elevated levels at the current state, and actually make debt servicing harder. So we also see some progress for capital gains there. Now there are risks, and I did mention a few. I mean, I mentioned the leveraging drive, perhaps leading to a spike in bond yields and investors flee. I don't think that's a risk for government bond markets, and we do see the People's Bank is mindful of providing sufficient liquidity for that not to happen. Another risk, of course, is that the capital outflows could pick up. And in particular, now is not the time for China to open up its capital account. The economy is as debt dependent as ever. Financing that with an increasingly large share of potentially fickle and footloose portfolio investment is not the goal. So for a portfolio investor, perhaps perversely, it's good to see the Chinese to keep a lid on capital, on the capital account, and not to deregulate the capital account too quickly. And then, of course, if there is additional adjustment coming and the Chinese move toward a more traditional monetary policy, which would involve an inflation target and interest rate implementation, that would allow us then to allow them to pay less attention on the exchange rate, such that bond investors might find benefit in hedging their positions. But by and large, I think it's an obvious attractive market.
This was Gerwin Bell from PGIM. Thank you very much, Gerwin, for being with us today and sharing your interesting views.
Thank you very much, Thomas, and have a great day.